Hello, everyone. Dave Landry here from DaveLandry.com. This is Trading Simplified. So, what are we talking about? Well, given the nature of the market, and knock on wood, methodology is doing fairly well, I thought now would be a good time to continue my discussion on surviving and prospering during tough times. And that'll make a lot more sense in just 1 minute. And even if things didn't work out as well as they did now, I would still follow the same plan. And I'll show you that in just 1 second. I'm going to continue my series on Jesse Livermore. I'm probably going to pick up the pace a little bit since some of the stuff has become repetitive, and he does seem to make a lot of the same mistakes. So do as he says, not as he does, and I'm going to drive that home in a few minutes. Housekeeping, I do take requests. These shows aren't live as they were a while back. I say a while back. It's probably been 2 years. But I still do a live show every week, and that's at davelandry.com/webinar. You can register there. I will be simulcasting soon. It's easy for me to say on YouTube with that, so you can keep an eye out on YouTube at Dave Landry. But for now, if you want to participate live and ask questions, go to davelandry.com/webinar. By the way, if you have a request for this show, you can go to davelandry.com/contact and let me know what you want me to cover, or just come to the live webinar on Thursdays. And ideally, let me know Thursday during the day, and I'll be happy to cover whatever you want. Webinars every Thursday except if I'm traveling or if there's a scheduling conflict. Anyway, my Twitter handle was also back there. And if you go to that link, davelandry.com/stockcharts, I'll give you my slides, my books in PDF format, and a bunch of other stuff to keep you busy for a long time, including limited access to the members area and a market timing course. All right, let's talk about the mystery charts and the methodology in action. So this stock is not a mystery chart. This is one that did trigger before I discussed it here. It's e.l.f. You can see it wasn't a longer term trend, and the moving averages were in uptrend proper order, meaning the 10 simple is greater than the 20 exponential, and 20 exponential is greater than the 30 exponential. As you can see here, here's a 10, here's the 20 exponential, and here's the 30 exponential. When they begin to meander back and forth, you get this yellow bit of a caution in here that the market could be turning, or in this case, the stock. When it's green, as a general statement, it is a good thing. However, you still want to draw a line and pay attention to what's happening in the charts. And you can see we had a bit of a double top here, and it wasn't making much forward progress, even though the moving averages flipped over back to uptrend proper order, as illustrated down below, where it is green down here. The market had lost some steam. I use the word market and stock interchangeably, by the way, but e.l.f. has lost some steam. And then you can see that it did bow tie to the downside, as illustrated below by the red. And by the way, this counts the number of bars that the condition is true. So over here, a little bit of caution as they're meandering back and forth for a few days in here. And then now we have 9 days of downside proper order. And right here we have a Landry bow tie. That means they've crossed over fairly quickly, going from green to red. Usually within 2 to 3 days, maybe 4 days is fine. In this case, it flipped over much quicker than that. We were green one day and then red the next. So that's the best signals. Also, with the bow tie, when the signal comes off of all-time highs, that's what you want to trade. I see a lot of emails from people and some tweets out there, people trading bow ties back and forth when the market's in a range. That's not what it's intended for. It's intended to be traded ideally off of all-time highs, sort of the bigger they are, the harder they fall, or major lows. In the case of stocks, all-time lows. Those are your best trend transitions. You want to make sure you're coming off that major high or major low, so the market is making a true trend transition, and the most amount of people are trapped on the wrong side of the market. Remember, everything I do from a technical analysis standpoint is psychologically based. So all these people that bought anywhere above this setup where it triggers here are going to be losing money if this stock begins to tank. Well, it did begin to tank, spoiler alert. So you can see it pulls back a little bit. That completes the pattern. All you need for a bow tie is one higher high and a higher low. Ideally, though, I do like several days of a pullback. But sometimes you get that one little tiny pullback like right here, and then the market begins to implode, and most of the market, or most of the people in the stock, I should say, are caught off guard. They're waiting for a much bigger rally to get off the hook, and that never does. materialize. Now, as you can see, the point risk was pretty big on this because it's a high price stock and fairly volatile. So we use 13 points, and that means you're only going to trade 154 shares per 100K account value. So entry was here, stop is up here. Remember, this is a short. We want it to go down, obviously, and the initial profit target is down here. And so far, so good. It triggered earlier today, and it's on its way to that IPT. It hasn't hit the IPT yet, but it did take an options position and was able to flip out half of those options at a double, so far at least. Now, you can see KBH, same sort of action happening there too. This is a short that triggered a while back. Longer term, still an uptrend, but again, pay attention to the actual chart too. Just because the moving averages are in uptrend proper order doesn't mean that the stock is 100% okay. As a general statement, I put good down here. It is good that they're in uptrend proper order. But notice that it did lose some steam. And notice like the net price movement, especially over here, you're right around where you were several months prior. And then obviously same thing happens here. The further you drop, the more people who bought above that level or underwater. So again, 10 greater than 20 and 20 greater than 30. Always, always, always look at the charts. The reason you hear me say the word illustrator when looking down here at the indicator panel is because they do not indicate, indicators do not indicate anything. They help to illustrate what's happening in the chart. An indicator is a derivative of price. Price will be first derivative because it's not a derivative, and then the indicator would be a second derivative. It derives its value from price. So again, even though they remain in uptrend proper order, you can see this market lost steam, beginning to top out in here. You don't just short it because it's topping out, although in this case it did work. I can guarantee you it won't always work. You want to wait for that confirmation. But you can see the bow ties. In this case, it took a couple of days to flip over, but it happened fairly quickly. We went from green to red. Red being 10 less than 20, 20 less than 30. 10 simple, 20 exponential, 30 exponential. And you can see there's the Landry bow tie right there. It looks like a bow tie, kind of on its side. Little bit of a pullback. All you need is a one-day rally, a higher high and a higher low. In this case, we had a couple days. And the entry was right here, actually right here, and stop up here, and initial profit target down here. Now, what's kind of interesting is if you look at the chart, and again, here's the parameters. And by the way, if you go in and watch the archives of the trading service, you can find the newer ones on my YouTube channel, which is at Dave Landry. You should be able to find this trade in there, and if not, you can go to davelandry.com/archives and look at many, many years of the trading archives to see these setups. And by the way, this is where all the mystery charts come from, straight from my trading service. Now, what's interesting is anything above this entry, obviously, you're underwater, and it did come dangerously close to stopping us out. But instead of bailing early, we just followed the plan. I know, easier said than done, but for me, because I'm putting out a trading plan every day for the world to see, or at least the paying customers to see, I have to follow that plan. So I did short the e.l.f. that I talked about earlier, and obviously I bought some puts on it too, as I just mentioned, and I did short this KBH, and I hate to use the word hope, but hopefully I'll be covering half of it later today. So far so good, or ote, as Buckwheat would say, with today's little breakdown. It's starting to look better and better and better. And also, by the way, anybody who bought the stock above 44.11, and that's a lot of people, are now losing money, and they're having to rethink their investment. Yes, the fundamentals may have changed. Yes, interest rates have skyrocketed. Yes, bonds have banged out new lows as of yesterday. So all these things are really negative for a home builder, obviously, but that doesn't matter. The only thing that matters is price. In this case, so far, so good. So here's the open portfolio, and what I want to show you here is these down here with a minus in front of them. Those are shorts. That's the way I designed a spreadsheet. And if you put your name in to the aforementioned link, www.davelandry.com/stockcharts, you get a copy of this tracking sheet so you can put in your own trades. By the way, the hypothetical account size is 100K. Again, I do take these trades. I have a model account where I like to mimic them as close as possible to this 100K account in here. So 2% risk would be $2,000, okay, if stopped out. And you divide that by the point risk, which is over here. This is your initial risk and your goal, okay, or your initial profit target, I should say. And that gives you the number of shares. Notice as this number gets smaller, you put on more and more shares. And then as it gets bigger, you put on fewer shares. So what's kind of interesting is as I was putting together these slides, I just noticed that these two triggered right around the market top. Now, we didn't know the market had topped at the moment. It does take a little while, as I just showed with some of these stocks. With KBH, for instance, took a while to roll over, as did e.l.f. But in perfect hindsight, that was the top. And even though that it turned out to be the top, these two stocks, knock on wood, turned out okay so far, at least. So here are our two longs coming into this slide. And again, okay, so far, so good. Knock on wood. Come in. I need some new jokes. So the bottom line is plan your trade and trade your plan. Now, again, I'm doing a trading service here, so I'm forced to follow that plan. So if somebody says, hey, Dave, where'd you get in on this? Or what did you do? Or how'd you manage this? I could say, here you go. Here's the actual trades. So what I would encourage you to do is if you're making your own trading plan, maybe show that plan to somebody else and have them hold you accountable, or just ideally longer term, you just want to hold yourself accountable. And as I preach, you want to see each position to its fruition. So you take a look at that KBH, and we were underwater for quite some time. Not every trade is like the e.l.f. I wish it was. Of course, let's not start kissing each other just yet because we haven't hit that IPT, initial profit target. But something like KBH took a while to begin to work. Also, LFMD, which I'll show you in just a few minutes, that one just chopped sideways forever, and we stared at a loss for weeks on end. All right, let's shift gears and get back to mind the trade. So each week, obviously, for a long time, we've been doing a series on Jesse Livermore, and I'm pulling mostly from Reminiscence of a Stock Operator, although I have used the biography for a little color commentary here and there. And then eventually I'm going to do a quick summary, possibly, of how to trade in stocks. But most of the wisdom comes straight from Reminiscence. I would encourage you to read this biography by Smitten because he does add a lot of color commentary and some of the stuff that Livermore discussed in Reminiscence. But always read Reminiscence first. Now, we last left off, Livermore was being philosophical about gaining intuition through experience. After years at the game, it becomes a habit to keep posted. He acts almost automatically. He acquires the invaluable professional attitude, and that enables him to beat the game at times. Now, notice he said at times, and that's kind of interesting because no one can beat the market all the time. We just had a pretty good little run here in spite of the market. I'm very proud of that. It makes for a great example following the plan, but sometimes following the plan just flat out doesn't work. It, spelled with a silent SH, happens. So Livermore, on watching the tape, experience has taught me that the way a market behaves is an excellent guide for an operator to follow. It is like taking a patient's temperature and pulse, or noting the color of their eyeballs and the coating of their tongue. So watch the tape, and if the market is headed higher, it is healthy. If the market is headed lower, it is not. If the market is headed sideways as a trend follower, it's neither good nor bad, but you should not be putting capital into harm's way. It's bad for a trend follower. So use something like the zone charts we talked about a little bit over the past several weeks with the TFM 10% system. I will update that on Thursday in my chart show. And again, davelerner.com/webinar if you want to attend that. Now, let's shift gears and talk about Livermore on sectors and stocks within the sector and sector confirmation or lack thereof, of course. What I like to look for in these sectors, if I find a stock I like recently I found the home builders, KBH, obviously, and I thought it was a good short, but I also looked at all the other home builders to make sure that they also look like they were in trouble. And ideally, you want to make sure there's some other stocks within the sector that are set up. I never buy a stock, even a bull market, if it doesn't act as it ought to act in that kind of market. Well, do as he said, not as he does. As you'll see in a minute, he went against that rule a little bit. I have sometimes bought a stock during an undoubted bull market and found out that other stocks in the same group were not acting bullishly, and I have sold out the stock. Why? Experience tells me that it is not wise to buck against what I may call the manifest group tendency. Sometimes you'll have a sector that's headed higher, and when you look within the sector, you'll notice there's only one or two stocks that are really trending, and the vast majority of stocks within the sector are headed lower. That doesn't mean that you shouldn't take the setup. If you really like the setup and it's a beautiful setup, then by all means knock yourself out. But if you see some problems within the sector, I like to call it the sexy sisters or sexy brothers, whatever you're into. I guess if you're into both, you're just greedy. I like to look to see if there's some sexy sisters and brothers, and ideally if they're set up too. If you do take a setup without sector confirmation or confirmation within stocks in the sector, just make sure it's an FYES setup. It's a setup to where if you took it and lost money, you could care less because you know it's a setup you should take. So do that little pre-mortem that I talk about quite often and do that little time travel where it fails miserably. Okay, just make up, pretend it fails miserably and see how you would react to that. So Livermore talked a lot about paying attention to the market action. If I'm walking along a railroad track and I see a trade coming toward me at 60 miles an hour, do I keep on walking on the ties? Friend, I step aside, and I do not even pat myself on the back for being wise and prudent. So as things began to deteriorate, we lost steam in the S&P 500. Bonds started banging out some new lows. A lot of stocks began rolling over. Sector after sector, sans the energies recently began to roll over. So a lot of ugly signs out there. Doesn't mean it's the end of the world just yet, but now I'm beginning to wonder if you could see it from here. So pay attention to market action, obviously. A stock wasn't behaving properly. Others in the group were headed higher. So he became super bearish on the stock. When the men who ought to want a stock don't want it, why should I want it? I figured that no matter how prosperous other auto companies may be, it was essential to sell just a short. Experience has taught me to beware of buying a stock that refuses to follow the group leader. I am not telling you this to moralize on the public's losses through their buying of Guyana. Guyana was a stock that he was bearish on, or my profit through my selling of it, but to emphasize how important the study of group behaviorism is and how its lessons are disregarded by inadequately equipped traders, big and little. And it is not only in the stock market that the tape warns you. So his point is, pay attention to the sector action. If you find something that you like, make sure you find some confirmation. In an ideal world, the stock is set up, the sector is set up, and the overall market is set up. The next best thing obviously would be a trending sector, and ideally stocks within the sector also trending, as I said earlier, and hopefully some are set up. And you want the market itself obviously to be trending, and then the setup itself should be an FYES setup. Now, sometimes you only get a couple of those things, and I call it the meatloaf trade because 2 out of 3 ain't bad. Livermore did very well in stocks, but he neglected his cotton position. He decided to take a vacation and ended up down $1 million on his cotton position. So once again, even though Livermore was doing incredibly well, he just plowed tons and tons and tons of money into cotton, shorting it. And also, the other thing he did was he got in early. He got in a year early in this particular case, and that was a really bad idea. Livermore always says, wait for confirmation in the tape, but in this case, he didn't do it. So here's yet another example of, it helps to know a little bit about trading to know when he is behaving badly and to know what takeaways are true takeaways. And I'll summarize those in just a few minutes. As I said, my stock deal was so interesting and I was doing so well in that I did not wish to take my mind off of it. Well, you got to be careful. There's a lot of distractions in trading, and if you're doing really well in one area, you tend to forget about things that aren't doing really well, and you might not honor your stops, and you might fall into a lot of behavior. So I think it helps to know a little bit about trading before reading Livermore, and that's why I would recommend you reread Reminiscence, especially every year, because you'll pull more and more from the book, and then you'll realize that, well, maybe he wasn't as perfect as he acted. Whenever I thought of cotton, I just said to myself, I'll wait for a reaction to cover. Well, that's a horrible thing to do. Basically, he was looking to get off the hook as opposed to having a stop in mind, and he also over leveraged to begin with, and that's why he was down $1 million. The price would react a little, but before I could decide to take my loss and cover, the price would rally again and go higher than ever. So as cotton went higher, he lost more and more money. Finally, by the time I had been in Hot Springs for a few days, he was famous for taking these vacations and then ending up back at work after trying to relax for a while. In this case, he was on vacation and he was $1 million to the bad. Finally, by the time I'd been in Hot Springs a few days, I was $1 million to the bad and no let up in the rising tendency. I thought over all I had done and I had not done and said to myself, I must be wrong. With me to feel that I am wrong and decide to get out or practically one process. So I covered at a loss of about 1 million. Well, you don't necessarily want to cover just because you feel wrong. You want to cover when your plan says to cover. Just like we sat through the bad times in KBH, we were not throwing caution to the wind. We were simply following the plan. So have a plan first. The subconscious mind probably went on working, reaching conclusions for me. The decision to sell in Washington was a result of my observation. So he ended up back in Washington after his brief stint on vacation. My years of experience in trading told me that the line of least resistance had changed from up to down. I bore the cotton market no grudge for taking $1 million out of me, and I did not hate myself for making a mistake of that caliber any more than I felt proud for covering Philadelphia and making up my loss. My trading mind concerns itself with trading problems, and I think I'm justified in asserting that I made up my first loss because I had the experience and the memory. So even though he gets off track, he loses a ton of money, and sometimes he blows up. Then he comes back by doing what he should do. So if there's any lesson to take away there is follow your plan and don't over leverage and let the chips fall where they may, as I just showed you with following the methodology through bad times. Now, Livermore once again goes fishing, but is drawn back into the markets after seeing a newspaper, and he kept shorting this tropical trading. So he ended up short 10,000 shares and returned to New York once again, kind of a reoccurring pattern. Now, he spent a lot of time studying insiders, and he determined that it was being manipulated by them. And he ended up short 30,000 shares. Now, I'm not sure that this type of analysis would work in this day and age. I'm not sure how you would go about doing that. I've been thinking a lot about this, and I think that the markets back then were a little bit smaller, a lot smaller than they are now. And it was a little bit easier to figure out who's doing what, when, and where. In a case like this, he felt like the insiders were propping it up. And as soon as those insiders ran out of money or stopped propping it up, it would implode. So I don't have a problem with that type of analysis. And I'll give you an example. And it's not my story to tell, so I don't know what I could say and what I can't. But let me just kind of give you a thumbnail of this. I know a trader for a firm, a hedge fund, and the hedge fund operator was onto a stock that was a scam. And he kept shorting and shorting and shorting, and the stock kept going higher and higher and higher. I'm not sure how it all ended and whether or not he was vindicated, but I know he lost a ton of money in the process. So Livermore was right on this. but the tape was not confirming what he said. So if you want to use, God forbid, fundamentals or something like that, fundamentals, then knock yourself out, but wait for the tape to tell you what to do. If you want to short a stock on bad fundamentals or because rates are rising or whatever the case, like we shorted these home builders, okay, all that stuff might be true, but that's not how it came to my decision. It came to my decision because they were going down. That's why they call me a trend following moron. Initially, I was a little aggravated and depressed and angry when someone called me that because it was a famous trader, but I grew to embrace the title because when I tried to outsmart the market, I lost money. When I just followed along like a good little trend following moron, I made money. There was nothing in the character of the rally from 133 to 150 to frighten me in covering, and presently the stock, as to be expected, started going down again. Well, to me, when I read into this a little bit, it sounds like he didn't have a plan in place. Now, getting back to the plans, we talked about LFMD quite a bit as a dead money type of issue. And by letting the stock go against us for weeks and almost a month, actually a month or so in here, we were not throwing caution to the wind. We were just simply following the original plan that said bailout if this stock is hit. And knock on wood, this one actually worked. Today notwithstanding. Well, earlier today was working pretty good. I stayed pat throughout because I knew my position was sound. Well, that's not really a good idea to do that unless he initially went into it and said, I'm going to hang on to 150. You have to have some kind of uncle point in mind where you will admit you're wrong, even though the company might be a scam or being put up or whatever the reasoning you determine to be short or long the stock. I wasn't bucking the trend of the market or going against basic conditions, but the reverse. And that was what made me so sure of the failure and an overconfident inside click. What they tried to do, others had tried before, and it always failed. So basically, he deduced that the insiders were trying to prop it up, which, again, I doubt that you'll be able to do that today, that type of analysis today. But what you could do is look for bow ties and other analysis like that to determine that the trend has turned, and then be a good little trend following moron and hop on that trend. The frequent rallies, even when I knew as well as anybody that they were due, could not frighten me. I do much better in the end by staying pat than by trying to cover to put out a new short line at higher price. By sticking to the position that I felt was right, I made over $1 million. Well, one thing in the markets that happens quite often is you could behave badly and make a lot of money. And the market has taught you to continue to behave badly. The market can be a very bad teacher. It kind of reminds me of Keynes and getting back to the aforementioned hedge fund manager that just kept shorting this stock even though it was going up. It's kind of like Michael Berry too in the Big Short, and I recommend you do watch that movie. And he was right, but early, and that's he got screamed at for that. And being right but early is the same thing as being wrong. Now, he ended up making out okay, but he could have easily gotten wiped out in the process and nearly did. It reminds me of what Keynes once said, markets can remain irrational longer than you can remain solvent. So you'll run out of money before the market does what it should do rationally in certain cases. So you can't just be obstinate because of your beliefs. As I often say, don't confuse the issue with facts. Now, the way he got out of this position was he began short selling another stock, which held the tropical stock. And this is similar to what he did when he was stuck in corn and started shorting oats heavily. Now, this is obviously not a viable strategy unless you're this huge operator. And even if you are this huge operator, like, again, the hedge fund, not to beat the dead horse, or Michael Berry or other people like that, you could still get into a lot of trouble and you could still blow up, as Livermore did quite often. So here's some takeaways. It's very important to know trading. This is something I didn't really realize up until now that I'm kind of going through all this sort of fine-tooth comb. But it is important to know trading so you can recognize when Livermore is behaving badly, and don't do that. Do learn to do what he says, not everything that he does. So that tropical position could have easily gone another 20 or 30 points higher and blown up Livermore once again. So again, over leveraging, as Livermore did quite often, he would just go for the juggler on these positions. And that's a really bad idea. And I believe in risking 2%, as I showed earlier, on every position if stopped out. And believe me, 2% is plenty enough money. On a 100K account, you get hit for 2%. That's $2,000. That's a substantial amount of money. So again, he over leveraged. Even though he made a lot of money, he could have easily blown up again in both the cotton trade and in this stock that he was short, TT. Now, he became married to his positions because he believed so strongly that it would work out. Now, there's an old Wall Street adage that comes to mind: strong opinions loosely held. And that's where you need to be. Whenever I go into a stock, I feel confident from the bottom of my heart it's going to work, but I have a stop in place just in case it doesn't. So again, strong opinions loosely held. Now, he did use some schemes to unload his positions. I don't think these would work in present day, but he began shorting a stock heavily that held the stock that he was short, held a lot of shares of the short stock that he was short, and that sort of began to unwind itself, and that helped get him off the hook. So don't try any schemes, believe me, it's a bad idea. Well, that's my time for this week. I want to, as usual, thank all you guys for watching. If you need follow-up information, again, davelerner.com/stockcharts. If you need to reach me, davelerner.com/contact. Join me on Thursdays, most Thursdays, at davelander.com/webinar for a live webinar. Bring your questions and favorite stock picks. You can find me on X at tfollowingmoron and on YouTube at Dave Lerner. By the way, if you like this video, like it. And if you don't like it, go have no fun somewhere else. I'm half kidding. But please leave a comment below if you would like, if there's something that interests you, or if you have a question. And I do read all comments and I answer when applicable. So again, thanks for watching, and may the trend be with you.